up, we have a panel that'll focus on future leaders within the institutional allocator community, and we'll ask, how will the future be different, especially if programs like GAIN are successful? We have a fantastic panel of speakers, so without further ado, please welcome them to the stage. We have Jake Conway, Vice President, Pension Investments Worldwide at the Eastman Kodak Company, Amy Flakursky, Managing Director, Global Leadership Team, Head of External Portfolio Management at CPP, Liza Scott, Director of Asset Management at Dominion Energy Investments, and Stephen William, Director at Teacher Retirement Systems of Texas, along with today's moderator, Rahul Mudgal, Partner at Parvis Asset Management. Rahul, stage is yours.
Good afternoon, everyone. Thank you so much for joining us. We've got a wonderful panel of smart, thoughtful, innovative investors with us today. Rather than introduce them to you, I thought I'd give you 4 facts, and you could determine who owns each of those facts while they're talking. At the end, we'll unveil who owns which fact. So one of our panel members has had breakfast with Charlie Munger. One trained at the Nick Bottarelli Tennis Academy for 2 years. One had a near-death experience hanging off a cliff for 30 minutes. And one would train as a doctor if she won the lottery. So have a think about who owns which fact. So interesting times we live in. So I'd really like to start, Stephen, with you, and all of you to follow up what you're working on right now and why.
What am I working on and why? So I run the market neutral hedge fund program at Texas Teachers, and what we are trying to do right now is crack macro co-invest. So that's literally like, the thing I've been working on the last few weeks. We have a very robust public and private co-invest function on the equity side and credit side, but we feel like there's a big sort of gaping addressable opportunity. A number of managers are rolling out these ideas, and we're trying to figure out how to do it smartly. How do we not blow ourselves up? So that's kind of a taste of what I'm working on right now.
Amy?
Sure. Similarly, we're a large organization that invests quite heavily into hedge funds and asset managers. So we have a broad, diversified portfolio, and what we're looking for is kind of things that are additional and additive. So right now, we've done some work in the credit long-short space, given a potentially materializing opportunity set in that direction. And then we've also been looking at, in the equity long-short space, the healthcare sector, given its uncorrelated profile to the macro environment.
Jake?
Yeah, I think similar to what you just heard, our portfolio is about 3/4 alternatives. And so at Kodak, 50% of that is hedge funds, about 25% is in the ground private equity. And so where we're spending quite a bit of time right now is very diversified. It's very bottom-up, the approach that we take. So, for example, on the hedge fund side, European distressed credit is pretty interesting, just in light of the inflation situation over there, the potential for their energy crisis to get worse. We think that there's an opportunity set there. We have a very active co-investment program as well. We're awash in co-invest opportunities on the private equity side. If you believe in long-term scientific innovation, we think biotech isn't an area that can be ignored. So we're looking for long-biased opportunities in that opportunity set. And then just from a process standpoint, I think we're always looking to kind of sharpen our internal tools for how we manage the portfolio. And just an example of that in terms of what we're working on right now is developing a set of quantitative tools to inform and catalyze discussion as it relates to add and trim decisions.
Oh, quite interesting. Liza?
So I oversee the pension at Dominion Energy, and so just given the time of year, I'm focused on board investment committee prep and analyzing 2022 performance. I guess the only good news about 2022 for corporate pensions was funded status held up, and we're in a good spot there. So exploring, different de-risking measures we could take to lock in some of that funded status. And then similarly to what everyone else said, we're looking for, well, we're expanding into some asset classes we historically haven't had a lot of exposure, like credit and absolute return. And so just continuing to build out those portions of the portfolio.
So leading on to the next question, what scares you right now then, Liza, when you're sort of looking at the world and opportunities?
Well, as everyone's aware, there's a lot of conferences going on right now, so I feel like I've heard a lot of views, and I'm a little worried about, and just seeing the January market performance, I'm a little worried about how consensus it is that like there's going to be a soft landing and the worst is behind us, and you know, the Fed will start cutting rates at the end of this year. I mean, except for the Jim Chanos panel, that was not that view, but just a little nervous that I don't quite believe that, you know, it's all over. So.
Stephen?
So I heard some interesting facts the other day. Anybody who's involved in hedge funds has known that over the last 4 or 5 years, the amount of assets in large, levered, multi-strategy platform funds has gone up a lot. A lot of people hiring those managers, and they've done well. And you know, frankly, we have a lot of investment there. But even like the B players are selling out, and some of the C players are selling out, and these are all very leveraged funds. And you always hear like, oh, risk parity or CTAs are going to blow up the market. What scares me is that you get into a large, sustained unwind with a lot of these levered platforms who have overlapping positions, selling, hitting NAV triggers, causing contagion, causing a big market problem. One stat, and then I'll just shut up. 75% of hedge fund trading is now being done through platforms. Heard that the other day. So that's a little scary to me.
When you mean selling out, you mean closing? Like C players are closing?
Yeah, selling out, like selling all their
selling out.
capacity,
Yeah.
like raising a ton of money. You know, there's people I wouldn't give money to that are, you know, getting loads of capital.
Amy?
Maybe picking up from what Stephen was just saying, the other side of the multi-PM model is the cost pass-through, and I think there's a lot of difficult aspects around that as an allocator, just fees going up, worse terms, and then a bit of a copycat approach for, like what Stephen was saying, just a cascade down in the industry. So I think that can be challenging, and we need to be more aware of that. And then I'd say second, from what Liza was saying, is just the really big swings in market days, like the CPI print in November, just very big macro vol, either up or down, is pretty difficult for some of the strategies as well.
Jake?
Yeah, so I think at the highest level, from a portfolio management standpoint, I think the obvious one is just the magnitude and direction of interest rate change. Obviously, that has a very meaningful impact on pension plans. As I mentioned a minute ago, we're also private equity investors, and so with that increase in interest rates, we're starting to see debt availability become quite a bit more difficult. We're anecdotally starting to see and hear of all equity deals, and so one concern that I have personally is just questioning the sustainability of the past 10 years of returns in private markets, if that's the structure of deals going forward, even for the next 12 to 18 months. What are returns in private equity markets going to look like? And then I think from a public market standpoint, for all the benefits that a China reopening certainly has, I do query what impact that will have on U.S. markets, as Chinese demand is likely to be more consumption-driven. I think, as we all know, the U.S. doesn't export a ton into China, and so we're unlikely to benefit from that reopening and that demand-driven by consumption. And so, in an environment where the U.S. growth is weakening and slowing, and we're living in a high inflation world, I think that causes some interesting dynamics for U.S. equity investors.
Interesting. So you talked about the platforms. Start with you, Stephen, again. Stephen, Amy particularly, you run huge pools of capital. How do you think about emerging managers or small niche managers?
Well, every manager that we hire used to be an emerging manager, so I think it's very important. We have a very robust emerging manager program at Texas Teachers. It's critical to our pipeline on the public and private side. But I can't do a lot of that in my portfolio because I need scale. So we're writing $500–600 million checks. The portfolio is about $10 billion. We can't do that with emerging managers, but it is important to have a pipeline in place because, like I said, tomorrow's investments are emerging managers today.
So those are more, you're looking for future leaders really, where you can put money to work and hope that they will grow rather than trying to allocate capital. Because
that is an explicit goal of our emerging manager program, is to graduate them into the flagship portfolios on all asset classes at Texas Teachers.
Amy?
Yeah, emerging managers are core. It's one of the 3 core pillars of our program at the Canada Pension Plan Investment Board in terms of hedge fund allocation. Like Texas Teachers, we think about it as essential in terms of development of the industry, development of future talent, as of course we see the largest managers, founders who are in their 60s, 70s and older. That talent will naturally change in terms of succession. And it's important, I think, to invest in both new strategies, new managers. I think we think about it as similarly to Stephen. Ideally, the home run case is that they launch, there's early success, and that they do graduate and become an established core manager, and we continue to stay invested and secure terms and capacity early on. So it's really critical for us. We certainly have more in the kind of established camp in terms of our portfolio, but we do about 2 to 4 new emerging manager investments per year and are seeking to innovate further around the emerging manager space.
Interesting. So Jake and Liza, you both come from endowments. How much has the Yale model influenced how you invest now that you're not an endowment?
Yeah, because I started an endowment, it was hugely important to how I learned this business. The particular endowment I was at didn't have quite as much as in illiquids and probably cared a little more about volatility, but and that's actually similar to where I am now. But yeah, really the core principles still apply, trying to find superior active managers, taking a long-term time horizon. I know emerging managers was a large part of the Yale model. I'm still struggling with how to apply that at a place that writes a bigger check size, and there are ERISA limits on some fund capacity. So trying to figure out what that looks like in this setting. I'll be curious how Jake handles that. But yeah, the core principles actually do apply. We're still an equity-oriented fund for the time being. So like I said, we don't have as much in illiquids, but I'm building the alternative exposure. So surprisingly, I haven't had to make as many adjustments as you would think.
Jake?
I think the direct answer to the question, in my opinion, is that it's had a significant and profound impact on how I personally view the world. I think there are different variants of the Yale model, though, right? And in the models at the institutions I've worked at, I would say have been Yale light, just in terms of the levels of illiquidity that we've allocated to at those institutions. But no, I think when you're building a portfolio that's largely comprised of alternatives, there's no other way to say it than the Yale model, I think, has influenced everybody in this room in some capacity.
So you can see the clock's ticking very quickly. So shall we start by, I said to each of the panelists that I'd like them all to ask a fellow panelist a question, because I think that's much more interesting than my questions. So Jake, can we start with you asking Liza a question, please?
Oh.
What gets you out of bed in the morning? Like, why are you motivated to do this type of work?
Yeah, so I completely fell into the allocator role. In college and business school, I didn't know this existed, and fell into a job in an endowment. I've ended up loving it and staying there for 11 years. Now I'm at a pension, and to me, it's like the most intellectually fascinating job. Like, never get bored. It's easier to see the connection to a cause when you work at an E&F, but I feel good about securing the retirement of people that have worked their whole lives literally keeping the lights on. So I take pride in that. And then now that I'm running a team, I take a lot of joy in building their careers and giving them a great experience and development. So that's about it.
Great. Liza, Stephen?
So I recently read about Texas teachers building their commodity exposure, not just last year, but over the long term.
Right.
And so I'm just curious, what role in the portfolio that serves and kind of your best ideas on implementation, whether it's...
Yeah, so we've got it in a number of spots. So we've got it, we have an energy, natural resources, and infrastructure vertical, which is obviously very geared towards that kind of thing. Mostly private investments. That's been in place for about 8 to 10 years now and has done extremely well, especially last year was excellent. We've also got it in liquid form, long commodities in our internal risk parity portfolio, as well as sort of a side piece that allows us to scale up a commodity exposure whenever we want that. And then the final place where we have it is in a less beta-oriented format in market-neutral hedge funds, where we've got quite a number of managers doing liquid commodities, illiquid commodities, systematic, discretionary, onshore Chinese commodities, things of that nature. And it's been really good for us. 2 years ago, it contributed about half of our P&L in the calendar year. Last year, it was about a third. And it's an inefficient space, lots of volatility. If you can find someone who can risk manage well, because that's the most important piece, it can be a very diversifying, interesting, high alpha source of return for a portfolio.
Was there a long time where you couldn't find managers in that space?
Yeah, they all blew. Well, in the hedge fund piece, they all blew up in like 2010 to 2014. Like every week you'd open up, FT, and it's like, commodity fund blew up. It's just like, okay, that's this week's news. Those were mostly highly directional, levered folks. We found plenty of people doing something a little bit more subdued and a little more interesting that had a more sustainable edge, and so we've been building that kind of exposure up over time. But yeah, I mean, it can be dicey. I'm from Texas, so I might get in trouble for saying this, but don't hire a cowboy to run your commodities funds because they will blow up.
Great, thank you. Stephen, do you want to ask Amy a question, please?
What is the worst thing you could invest in right now? The worst.
It's a personal view, but I think, fractional ownership in digital art would be what I would come up with.
All right.
Not too keen on that.
And Amy, that's great.
Yeah, Jake, what are you actively learning right now?
That's a good one. A lot. So this has been my first year at Kodak. I spent 8 years prior to that at an endowment and 4 years prior to that at a multifamily office. I think one of the coolest things about this job is that we're always learning something, and one of the best things that my colleagues have been teaching me over the past year is creating new frameworks for problem solving. I think that it's been a really interesting way to attack different issues. And it's a framework that's applied to every single thing we do, no matter what the problem is. We're always creating a matrix. We're always creating some way of framing what the problem is and then trying to answer a specific set of questions to get to an answer for that. So, I mean, it can be anything from underwriting managers in a due diligence process, developing KPIs for tracking managers in our existing portfolio, creating different frameworks, as I mentioned earlier, for deciding or discussing how to trim and add from specific investments. And then I think just because it's been the first year at a pension, understanding how to effectively structure and execute a portable alpha program has been really interesting. So it's endless, and I think that's one of the best parts of doing this work is that no 2 days are the same.
Great, we're really running out of time. So I'm going to end with the last question is, what skill do you possess what skill don't you possess right now that you think you'll need in the future? We'll start with Stephen.
Oh, man.
One word.
One word?
One word.
Really?
Yeah.
Oh, jeez.
No, 2 words if you want, honestly.
Three?
Sure, go for it.
Ultra long-termism. So, like, what I mean by that is, like, we all say we're long-term, but it is so hard to be.
So what is long-term? 3 years, 5 years, 10 years?
Well, I don't know. I mean, everybody has a different answer. And then but you can't just ask somebody that. You have to actually watch what they do, because people will say,
100%.
I invest for 10 years, and then they out of somebody in like a year and a half, right? Like, everybody's done that. So, like, And I struggle with that too. Everyone does. You just want to get rid of the thing that stinks. So like being ultra long term is a skill I don't have yet. Maybe I'll never have it, but I need to keep trying to get it.
Okay, Liza?
There's a different answer than I would have said yesterday, but today I realized I would like to learn more about how to play poker. I went to an event last night which had a professional poker player coaching, and I learned a lot that I think I can apply to my career.
So you're going to become a poker player managing pension fund assets?
No, it's like decision
You heard it here first.
All in.
Okay. No, I'm teasing you. Amy?
Energy and climate science knowledge, just given the energy transition.
Okay. Drake?
This is a people business at the end of the day, who we partner with on the GP side, but equally, if not more importantly, understanding what motivates and what makes people tick on our internal teams, and understanding how do you get those people to row in the same direction. So building a team and then building a culture around that to execute on a vision.
So important. So shall we do a reveal of who owns which fact? So hands up. Who trained 2 years at Nick Bollettieri Tennis Academy? Amy?
Wow.
Who had a near-death experience in Colorado when they fell down a rock side to hang off the cliff for 30 minutes?
Almost died on a cliff.
Who would retrain as a doctor if they won the lottery? And who had breakfast with Charlie Munger? There you go, guys.
What'd you eat?
Everything was from Costco, I swear to God. Costco sausage links, Costco muffins, Costco fruit, everything was from Costco. That's not a joke.
Thank you guys so much.